Okay, so good morning, everyone. Welcome to the new week. This is the macro snapshot for Monday, August the 1st, 2025. Recording this in the morning. Okay, so let's just review the fairly dramatic sort of market moves which we had last Friday, and then, of course, Trump's sort of reaction or overreaction to them. First of all, just want to just go back to the data. And obviously, I mean, I think everyone probably knows, but let's just review the fact that the employment numbers came out. And we had this, the actual sort of a change was plus 73,000, which was a little bit weak. But really what got the market's attention was the 2-month net revision minus 258,000. So that essentially looks at the previous 2 months. So going back to May and June, I believe, and it essentially stripped out those and revised those much lower. So essentially saying that over the last 3 months, rather than having an average of, sort of 150,000 or something, you could see here, this is the 3-month average. You see 150,000, which you could argue was, the narrative was, well, the US economy is not too bad, the labor market's not too bad. And suddenly you have an average of over 35,000, which is much, much less, obviously. And that's indicating a labor market which not only is weakening, but it potentially is already weak. And potentially people started thinking about sort of, is there an upcoming recession? And that the earlier comments, remember Waller and Michelle Bowman, who basically voted against the Fed decision to stay on hold on Wednesday. So they dissented. That essentially was bearing out Waller's point that, hey, the labor market was quite weak. So the market not only had to sort of readjust to sort of, let's call it weaker data, but the market really had to readjust a narrative. And we can see now that we've had a very, very, very sharp sort of repricing, mainly on Friday, of course, at 8:30 in the morning. And we can see now that for the September meeting, which had been at almost just a few basis points, that's now got 22.6 out of 25 basis points cut. So almost a full cut. So suddenly we've gone from almost nothing to sort of a 90% chance of a cut in September. And then if we go out to the end of the year, so December, now, I've been talking about this for a lot for the last weeks, and always it's been just over 2, just under 2, and then it slipped almost just to over 1. But suddenly here we are at 2.5. So now it's shot up to 2.5 cuts, which equates to 62 basis points. So not even 50, but 62 basis points. So we had an absolutely massive move. And if we can actually just see that, for example, if we look at the December pricing here, this is overnight index swaps. We can see it's just interesting to see that this is the intraday chart. So you can see here on Wednesday afternoon, this is when Powell was speaking at his press conference. And you see at that point, we started at under 2 cuts, 45 basis points. Then Powell essentially saying the labor market was solid and robust, and the market, no need to sort of cut interest rates soon. And you see the market got down to just over 30 basis points of cut. So just almost just one cut and a little bit. And then boom, on a Friday morning, we had this huge move, which it was down from about, let's say, about 33 basis points at one point, down to about 63 basis points. That's 30 basis points move, like a full cut priced in within sort of an hour or two. Then we sort of stabilize. So here we are on Monday morning at about 62 basis points. So just to give you a little sense of that, actually, I just want to show you the change. I wonder if we can have this from, let's say, a day ago. You can't really see it there. We'll go from, let's say, a week ago and just bring that up. So you can see from a week ago, just the huge change. So this is like last Monday. And you can see that the curve has moved downwards. So where we are now is the white. So the white is where we are now. This is in yield. So this is implied yield. And you can see, just zoom in a little bit, you can see that all across the SOFR curve, so each dot here represents 3 months going into the future. You can see that all the way across, this has come down a lot. And really, the big moves here, you see up to, as I say, 20, 25 basis points. Basically, the biggest moves coming in the middle of next year, so June, September, and December 2026. So now we're at a point where the market has substantially readjusted its pricing in a dovish fashion. And we can see here that the terminal rate, which I'll talk about in a second, the terminal rate is down around about sort of 3%. So the terminal rate being where the market believes the Fed will cut down to. So it's not super low. Historically, terminal rates, as we all know, actually they've gone down to, maybe 25 or 50 basis points. So still at relatively elevated levels from a historical perspective. Historical, I'm saying, let's say in the last 10 or 15 years. Obviously, we can go back a lot further, but still, a relatively high terminal rate, but a lot lower than it was, let's say, prior to the jobs number. So Just grab a little bit of tea. So we're at this point now where, apart from anything, we know that Trump didn't like the revisions, saying that the economy was weakening, and he promptly has fired the head of statistics, the head of the Bureau of Labor Statistics, which I find personally deeply shocking. And the issue is just in terms of the markets, is that all of these attempts to sort of whittle away independence of the Fed, whittle away independence of the Treasury, whittle away independence of the judiciary, whittle away independence of the sort of data collection. You have to say at some point this is very, very slowly, but maybe surely whittling away or reducing slowly sort of trust in the US financial system and sort of infrastructure and the whole sort of system of governance in the US. And there is a premium embedded into the US dollar and US Treasury bonds, which reflects that trust. And I'm not saying anything's going to happen today or tomorrow or next week or next month, but it's interesting. Maybe history will look back at this sort of constant undermining of sort of independence of these institutions and agencies from the White House. We shall see where that all leads to. But anyway, what the market is sort of focused on now, there's not too much data this week. The main thing we have just coming up today, we do have the bond auctions this week. So we have the 3s, the 10s, and the 30s. So that could just lead to the bond market just taking a bit of a pause and coming down in price and building in a little bit of a concession. So, the bond market absolutely ripped. We'll see on the charts in a second. So maybe with the 3s, 10s, and 30s auctions happening this week, we might just see those prices come off a little bit, which doesn't necessarily indicate that the short or the long-term bonds are sort of weak at this point, but just maybe a concession. But what we don't have this week is too much data. So if we actually look here, we can see, actually, let's just bring it up to today's date, which is the 4th. And so you can see here we have factory orders, durable goods. It's a final number. We do have prices. We have ISM services tomorrow, which again is a survey. It's not hard data, but the market's going to be pretty focused on that. Obviously, initial jobless claims later in the week, but the market is going to start really focusing on data, especially labor data, to see if these revisions, if there's any truth in what Trump is saying, that, these revisions, indicate sort of sloppy work, that they're not accurate, that they're politically motivated. Because really at this point, the market wants to know if this data, which we saw on Friday, is correct, if it's part of an ongoing pattern, if the economy and indeed the labor market is weakening. So it's going to be a lot of attention, even more than usual, on the data. We don't have a huge amount, but we do get some ISM services. Again, it's a survey, so let's see what happens. That we'll talk about that tomorrow. Okay, so let's just have a look and see the market reaction. I'll just start off with the 2-year yield, which got really one of the main moves. We see here this is the 2-year yield, so not the price. And you see the yield here, it had an absolutely massive move on Friday on the back of that information. So it came down about 28 basis points, which is a very, very big move. Maybe not the biggest in history, but certainly probably in the top 10 or 15% of major moves. So a very large move, 28%. And you have to say at this point, is there some kind of upside cap here? Because even if the data doesn't come in and immediately confirm what we saw last Friday at non-farm payrolls, the reality is that the Fed is not going to be will not be hiking and raising rates anytime soon. So you have to say on the upside, there's probably some kind of cap to where that could go up to maybe something like about 395 or so, somewhere up around here, where you have to say that the Fed at a bare minimum is going to be cutting at some point rather than hiking. So I think anytime the 2-year yield gets up to let's say something like into the 390s up here, or even a bit lower, but that could be a pretty interesting risk reward in terms of buying, let's say, the ZT, so the 2-year Treasury note at that point on the futures. And then if you look at the terminal rate, as I say, we also had Adriana Kugler, who was absent from last Wednesday's meeting. So this is a board member, the board of governors. She has actually resigned, and it's a bit murky as to why. Internal disagreements with Jerome Powell, who knows? But the point is that she has also resigned. So suddenly, before the September meeting, there's some talk that Trump might try and push through a nomination to replace her on the board of governors. And there's also the thought that her replacement might actually be his preferred choice for the next chairperson of the whole board of governors. So pretty important stuff. And we would have to assume as well that presumably someone who Powell would appoint would, want to toe the line, according Trump would want to sort of obey in loose terms Trump's sort of dovishness. So we have to assume that with this new sort of Fed governor probably going to be appointed or nominated relatively soon, and possibly the announcement of Powell's successor as well. We had Besant the other day saying there should be an announcement relatively soon about Powell's successor. You have to say the chances of a hawkish Fed are diminishing, and therefore something like the terminal rate, which we saw before, is down about 3%. So let's just refresh ourselves, and we see the terminal rate here of around about 3%. That's what the market is pricing in. You can see that. I'll just get rid of from 1 week ago. So you can see here that the terminal rate, is down around here, around it just over sort of 3%. And maybe that's enough, because if we consider that with the tariffs, there could still be some sort of sticky inflation, maybe even slightly increasing inflation. We could have an inflation rate like a core PCE, around about the late twos, like 2.8, 2.75, 2.9, even up to 3 or so, maybe sometime over the next 3 or 6 months. So if we assume that the core PCE, which is the preferred measure of the Fed, goes up a little bit over the next few months, and the Fed is cutting, you'd have to assume that the Fed wouldn't particularly want the Fed funds rate to be below 3%. They might want to reduce the Fed funds rate. Remember, the effective Fed funds rate at the moment is about 4.33%. So it's possible that they will cut, 3, 4 times, 3, 4, 5 times over the next, 12 months or so. But I can't see them assuming that inflation is still a little bit sticky. Even a dovish Fed and dovish chair, I can't see that person being prepared to have the terminal rate lower than 3%, because that would be accommodative. That would be too loose policy, which could risk, inflation really taking off and the economy overheating. So, a lot of the Fed members are talking about a mildly restrictive rate. So I think this is going to be coming down, and terminal could end up being, around about the inflation rate. So let's keep an eye on the core PCE and just see how that is in relationship to where the Fed funds rate is at that point. Okay, because otherwise, if the Fed reduces the Fed funds rate below the core PCE, so this sort of terminal rate goes below the core PCE, you might end up having a negative real rate, and that's probably not something which the Fed wants, and it would be a little bit too accommodative. Okay, so let's get back to some charts, and we can see just that move. As I say, on Friday we had the 2-year going down about 28 basis points. Now all across the curve the yield went down, but really once you start getting out to the 10s and the 30s, you can see the 30-year went down a lot less. So what we saw was a very big steepening. So even let's just go like the 2s to the 3s, the 2s to the 5s. Look at that, 2s to 5s. And then as soon as you get out to something like the 2s, 10s, you can see we had a huge steepening. And then if you go, let's say 2s, 30s, a massive steepening to the top of the range now at 114 basis points or so. And you look at the 530s, it's breaking out into new highs. So a massive steepening there. And I mean, that kind of makes sense, because who really wants to be buying duration? It makes sense to be buying the front end of the curve on the idea that maybe the economy is, or the labor market is weakening a little bit, and on the idea that there's going to be a more dovish composition of the Fed. So it does make sense that the 2-year or the front of the curve is going to be relatively anchored and relatively stable. And if anything, there's going to be a downward bias to the yields. But as soon as you go out to the 10s and the 30s and duration, who really wants that? Because you still have maybe a less aggressive Fed, you have still sticky inflation, and at this point you still have an economy which maybe is weakening a little bit, but still is relatively robust. So at this point, the steepener is the way to go. People will want maybe 2s, 3s, maybe even 5s, but anything longer than 5s it comports quite a lot of risk. And until and unless we have a recession. Now, I'm not saying a slowdown, I'm saying a recession. So a significant, like an aggressive slowdown, a recession, that there probably won't be too much demand for the long end of the curve. And again, the question here is, at the moment, do we have potentially a slowing economy, a weakening economy? Yes, we'll have to keep on watching the data, but we're still quite a long way from the recession. And I think really for yields on the back end of the curve, and for us to have a flattening, we would have to have a pretty dramatic, almost like sort of a very strong recession to get that happening. So at the moment, I think the bias is any dips you you buy steepeners rather than sort of selling steepeners at this point. So just looking at the yield curve, something like the twos, tens, you say, well, where can this go? You've got to say that this could definitely, at a minimum, get up to 65 basis points. So there's still more room to move there. If you look at something like the twos, 30s, that's already pushed out, and I see no reason why that can't push, another 15 or 20 basis points up to 130 or 110 over the next sort of month or two. I don't see any problem for that at all. But if we go over to, so you say, well, okay, is this a global phenomenon? But let's say we go over across to Germany. You can see that Germany, not a lot happened. The yield did come down on Friday, but not nearly as much as in the US. And that's just because the ECB, they've already cut, I think it's over 200 basis points. I'd have to double check, but the ECB has already cut significantly. They are waiting to see what happens to their own economy, and they're in no hurry to, sort of dramatically cut anymore. So really, at this point, I think what's going to be happening is that, the German yield curve, if we look at it, let's have a look. The German yield curve has already, steepened quite a lot. It maybe doesn't have to steepen that much more. And you can see these sort of dynamics at play if we look at the differential between the US 2-year and let's say the German 2-year. So we'll just take that as an example. And you can see here how those spreads have come in dramatically since last Friday. Before last Friday, they're at about 200 basis points in favor of the US. So that means the US yield was 200 basis points higher than the German yield, the equivalent German yield on the 2-year. But you can see that spread has come in about 20 basis points, over, well, since Friday. And the question then, can that come in more? I think it can actually, assuming that the Europeans don't particularly cut that much, the ECB, just, slightly longer term, you can see that this definitely has a little bit more downside. I think, can this come down to 130 or 150? I think it's possible. I think eventually this can get, first of all, to the 170 level. And then, assuming, or let's say that the Fed does start to cut, and maybe even there's some weakness in the US economy, those US, the yields at the front end of the US curve can definitely come down a lot more. So I see this spread here as, maybe going to test down to 170, and then it can even test maybe all the way down to 140 at some point, maybe over the next 3 to 6 months. So again, from a trading perspective, I think any sort of steepening in this sort of spread between the US 2-year and the German 2-year, that would be kind of a flattening, or at least a sort of a tightening of this spread. That could be definitely something kind of interesting down there. All right, so then that all begs the question, what about the US dollar? So if these sort of spreads are coming in, what about the US dollar? And if we go up to the US dollar, of course, it had a little sort of bounce, we know, for the last few weeks, but obviously it sort of failed at 100, which was also the 100-day moving average. So at the 100 level, and which coincided with the 100-day EMA, and of course coincided with the data on Friday. So that sort of apparently weaker sort of US labor market, the US dollar absolutely being whacked here. Now, the point is that can it come down a bit more? Probably can come down a little bit more, maybe around to 98 or so. But at this point, we probably need to see a confirmation of weakness generally in the economy, and specifically in the labor market, and some evidence maybe at Jackson Hole speech that the Fed indeed is prepared to start sort of cutting at some point. So I think we need to see all of that, and really we need to see the economic data confirming what we saw on Friday for the US dollar to have a significant extra fall downward. So it wouldn't surprise if the US dollar does kind of stabilize here, maybe at slightly lower levels down towards 98 or so. Maybe you'll find some support here at the 20 EMA. But basically, we'll need to see. So I think it's going to sort of stabilize for the next week or 2 or 3. Then we're going to get Jackson Hole at the end of August. We're going to start getting a bit more data, and that I think will determine whether this significant downtrend can continue, or whether we just sort of stabilize a little bit. We shall see. And again, let's start looking at stuff like on Tuesday the ISM services, which is just a survey, and then the initial jobless claims, which is going to be very, very carefully scrutinized this Thursday. And again, obviously, something like the euro on the back of that US dollar, weakness, had a nice sort of rip. Similar kind of situation here. It's got the 20-day moving average up above, just to sort of cap it at the top. Again, I'm not sure this is going to rip much higher suddenly in the next sort of few days. We're going to have to look at data both out of the Europe, but also especially the US, just to see the next trend there. I'm going to grab a little bit more tea. Other thing to sort of look at over the weekend is oil. We had the OPEC Plus meeting, and they came out with an increase to their output of I think it's about over 500,000 barrels. I think about 540,000 barrels, and the market's not really liking that. And as you can see here, a couple of things. You can see here that they were. It's just in this sort of downtrend. This big gray line here. I'll just zoom out a little bit. You see, there's a big downtrend, which has been going on for quite a long time. So that it seemed that oil couldn't really sort of push out of that, kind of failed there. It also couldn't push above like some of these moving averages here, like the 200 EMA, which is the thicker kind of orange one here. So just sort of having a bit of a stall out. But really what's happening here is that it's not as though the global economy is horrible, but the reality is we had, the confirmation on August the 1st of all these tariffs. It looks as though tariffs are going to be somewhere around about 15%. We still don't have any final clarity with China, also with Australia, but it's particularly China is a big issue. And so the market is essentially saying, hey, the global economy is okay, but there are headwinds. Maybe the US economy is weakening, and OPEC Plus is now increasing their output. And you put that together on Friday with the jobs number, which is indicating possibly a slowdown in the US economy, and then OPEC Plus increased production. And what you see is the double whammy that not only on Friday did the prices come down, but we saw the 6 p.m. open last night on the futures. You see oil now, and just all, very quickly, you can see that all of those moving averages, which was kind of going sideways, you can see now, if you look carefully, that we're actually now below the sort of 200-day and the 100-day and the 20-day, and there's the 50. So we're suddenly below those moving averages. And you've got to say that the easiest path for price of oil now is at a minimum maybe to test down to $65, down to these levels here. Let's see what happens there. Could have a little bit of a bounce or a sideways consolidation there, but that's I think it's got a little bit more to go, maybe at least another $1.50 just on the downside. Not a huge amount of positive energy with the oil market. Just in terms of volatility, just to finish off here, you see that vol obviously spiked on Friday with the bit of a fall in the equity market. And what's interesting, you see that there's something we got up to about 20. That's going to start putting a little bit of pressure. Even at the sort of incremental levels, there are a lot of funds which like specifically the vol control funds, which specifically target volatility levels. You have a lot of CTA funds which tend to reduce their position sizing as volatility goes up, just sort of mechanically. And so you have to say with, and this is not a huge amount of volatility, but we have gone from, let's say, a 15 handle up to 19 or 20. And so suddenly we've got implied daily moves of about 1.25% or so, and so that's just going to break a little bit of the fun times. And if we look at something like SPX, we can see here, this is the cash market. You can see it. What's interesting is that we had very positive earnings last week with the big companies, except you could maybe argue that Amazon's was a little more pessimistic, but the Metas and the Microsofts and the Nvidia, sorry, not Nvidia's, and the Googles were very, very positive. And even on that, then the market couldn't really rally too much. So you see that those earnings came in on the Wednesday and the Thursday, and we didn't really get too much sort of good news. And in fact, the markets sold those. And then, of course, on the Friday, we got the jobs numbers. So you can see here that just before the jobs number on Friday, the market was not exactly drinking the Kool-Aid, and even on the back of pretty solid earnings. And you have to say here that the possibility for SPX to come down is a possibility. And you can see here that this 20-day moving average hasn't been breached for quite a long time. We'd have to go basically all the way back to sort of the Liberation Day stuff. And you can see here now we're below the 20-day moving average. And it's possible, I think, that it could come back and test the 50-day moving average around about, what's that, about 61.20 or so. That's definitely a possibility to test back here. I don't anticipate that this is going to collapse. I think we would have to see significantly worsening data and a Fed resolutely determined not to cut interest rates and sort of other issues. But the reality is the economy is still chugging along. We will get interest rate cuts at some point. But having said that, I think something like, as I say, about 21.40, 21.20, 61, sorry, 61.40, 61.50 around there could be, could be a possible stop. I mean, it also could have just here about 6,200. I mean, maybe that's enough. It's already come down a few percent. Let's have a look on just the cash market here. It's already come down about 3%. So, it could even be some dip buys here. So I think if dip buyers don't come in here, certainly down around this 50-day EMA at about 61.40, 61.50 on the cash could be a good level. If we look over at the ES, you see that it is actually bouncing a little bit around about this level here, 62.50. Also, again, as I say, it wouldn't surprise me if it can dip down to this pretty key level on the ES futures, about 61.70 on the futures, which equates to the 50-day EMA. So let's keep an eye out for that. Similar kind of situation for NASDAQ. Again, if we look at the cash market, you can see, just talking about that, remember I was talking about the Bollinger Bands here. You can see that, as I was saying, that on the monthly Bollinger Bands, it's pretty rare for the equities, especially the NASDAQ, to actually spend any extended time above the monthly Bollinger Bands. And as you can see, going into the new month here of August, that in fact it is coming back a little bit. Not saying that's the reason, but generally, as you can see, doesn't like to spend too much time above the Bollinger Bands, even on the dailies here. Okay, guys, I want to leave it there. I think that's enough for the morning. We'll keep an eye on everything. Let's see if we get any updates on Trump wanting to replace Adriana Kugler on the board of the Fed. Any reaction from the Bureau of Labor Statistics? Tomorrow we have the ISM services, I believe. And let's just see how the bonds react and if the equities, if the dip is actually bought. And keep in mind that we do start to have the bond market cycle, the cycle of the bond market auctions, the 3s, the 10s, and the 30s. So even if we see the front end, I'm just looking over there, the front end coming off a few ticks, but I wouldn't think that's anything crazy or to worry about. We have to get through the auctions. Okay, thank you very much. Let's have a great week and we'll keep this going. Thank you.